Welcome to LuxScout Economic News and Strategies. The Federal Reserve remains laser-focused on combating inflation. The latest FOMC meeting minutes reveal a hawkish stance among policymakers. They express concerns about persistent price pressures and the need for further interest rate hikes. The Fed's commitment to taming inflation is evident in its aggressive monetary policy tightening. The minutes highlight the Fed's determination to bring inflation down to its 2% target. They acknowledge the progress made so far but emphasize that more needs to be done. The Fed's stance suggests that interest rates will continue to rise in the coming months. This hawkish outlook has significant implications for consumers and investors alike. The Fed's inflation fixation is driven by the belief that high inflation is detrimental to the economy. It erodes purchasing power, creates uncertainty, and can lead to a wage price spiral. By raising interest rates, the Fed aims to cool down the economy and bring inflation under control. However, this approach carries risks, as it could also trigger a recession. The minutes also reveal some divisions among FOMC members regarding the pace and magnitude of future rate hikes. Some members favor a more cautious approach, while others advocate for more aggressive action. This suggests that the Fed's policy path remains uncertain and data-dependent. The upcoming economic data releases, such as the June inflation report, will be crucial in shaping the Fed's next move. The Fed's aggressive interest rate hikes have made borrowing significantly more expensive. Over the past year, we've seen a steady climb in interest rates, which has had a profound impact on various sectors of the economy. Mortgage rates have surged to their highest levels in decades, cooling down the housing market. This has led to a noticeable decline in home sales and refinancing activities, as potential buyers and homeowners are deterred by the higher costs. Consumers are also feeling the pinch with higher interest rates on credit cards, auto loans, and other forms of debt. This increase in borrowing costs means that everyday expenses are becoming more burdensome for many families. The rising cost of borrowing is putting a strain on household budgets and weighing on consumer spending. Families are having to make tough choices, cutting back on non-essential purchases and prioritizing their spending more carefully. Businesses are also facing higher borrowing costs, which is making it more expensive to invest and expand. Small businesses in particular are finding it challenging to secure affordable financing, which could stifle innovation and growth. This could lead to slower economic growth and job creation. As businesses pull back on expansion plans, the ripple effect could be felt across the job market, potentially leading to higher unemployment rates. The Fed's rate hikes are intended to slow down the economy and bring inflation under control, but they also carry the risk of pushing the economy into a recession. The delicate balance between curbing inflation and maintaining economic stability is a challenging task. The impact of higher interest rates is already being felt in the economy. From reduced consumer spending to cautious business investments, the effects are widespread and significant. Consumer spending, which accounts for a significant portion of economic activity, has slowed down in recent months. Retailers are reporting lower sales figures, and the overall sentiment among consumers is one of caution. The housing market, which was booming during the pandemic, has also cooled off as mortgage rates have risen. This slowdown is not only affecting home buyers but also the construction industry and related sectors. The Fed will need to carefully monitor the impact of its rate hikes to avoid tipping the economy into a recession. Continuous assessment and adjustments will be crucial in navigating these turbulent times. Despite the risks, the Fed sees high interest rates as a necessary evil to combat inflation. They believe that the long-term benefits of controlling inflation outweigh the short-term economic pain. They argue that allowing inflation to spiral out of control would be far more damaging to the economy in the long run. High inflation can erode purchasing power and create uncertainty, which can be detrimental to economic stability. The Fed's challenge is to find the right balance between taming inflation and supporting economic growth. Striking this balance is essential to ensure a stable and prosperous economic future. The ADP non-farm employment change report for June showed continued job growth, but at a slower pace than in previous months. This report is a key indicator for economists and policymakers, as it provides an early glimpse into the state of the labor market. The report, which is closely watched as a preview to the government's official jobs report, indicated that private employers added 497,000 jobs in June, exceeding economists' expectations. This figure is significant because it suggests that businesses are still hiring, despite economic uncertainties. However, this was down from the revised 523,000 jobs added in May. The revision of previous months' data is a common practice and can sometimes provide a clearer picture of employment trends. While the June ADP report suggests that the labor market remains strong, there are signs that it may be starting to cool off. This cooling off is not necessarily a bad thing, as it could indicate a more sustainable pace of job growth. The slowdown in job growth could be a reflection of the Fed's interest rate hikes, which are intended to slow down the economy and bring inflation under control. Higher interest rates can make borrowing more expensive, which can lead to reduced spending and investment by businesses. The report also showed a decline in the average work week, which could be another sign of a softening labor market. A shorter work week might indicate that employers are cutting back on hours due to reduced demand for their products or services. The ADP report is just one data point, and it's important to note that it doesn't always accurately predict the government's official jobs report. The official report includes a broader range of data and can sometimes show different trends. However, it does provide some insights into the health of the labor market. For instance, it can highlight which sectors are experiencing growth and which are facing challenges. The Fed will be closely watching the upcoming government jobs report for July, which is due out next week, for further clues about the strength of the labor market. This report will be crucial in determining the Fed's next steps regarding monetary policy. Despite the slowdown in job growth, the unemployment rate remains near historic lows. This low unemployment rate suggests that most people who want a job can find one, which is a positive sign for the economy. This suggests that the labor market is still tight, with more job openings than there are available workers. A tight labor market can lead to increased competition for workers, which can drive up wages. This tight labor market is putting upward pressure on wages, which is contributing to inflation. Higher wages can increase consumer spending, which can drive up prices for goods and services. The Fed will be looking for signs that the labor market is cooling off in order to ease inflationary pressures. If the labor market cools, it could help to bring inflation down to more manageable levels, which would be beneficial for the overall economy. Service sector slowdown. Can the economy weather the dip? The ISM Services PMI report for June revealed a significant slowdown in the services sector, which accounts for a large portion of the U.S. economy. This report is closely watched by economists and policymakers as it provides a snapshot of the health of the services sector. The index fell to 53.9 in June, down from 55.9 in May, indicating slower growth in the sector. This decline is notable because it marks a significant drop in just 1 month, raising concerns about the sustainability of economic growth. This was the weakest reading since February and suggests that the services sector is facing headwinds from high inflation, rising interest rates, and slowing consumer spending. These factors are creating a challenging environment for businesses that rely heavily on consumer demand. The slowdown in the services sector is a concern because it is a key driver of economic growth. The services sector includes industries such as healthcare, finance, and retail, which are essential to the overall economy. The report showed that new orders and business activity both slowed in June, indicating weaker demand for services. This decline in new orders is particularly worrying as it suggests that businesses are not seeing the same level of future demand as they did earlier in the year. This slowdown could have ripple effects throughout the economy, as businesses may cut back on hiring and investment in response to weaker demand. Reduced hiring could lead to higher unemployment rates, which would further dampen consumer spending and economic growth. Despite the slowdown, the services sector is still growing, albeit at a slower pace. This continued growth, even if modest, provides some reassurance that the sector is not contracting. The index remains above 50, which indicates expansion in the sector. An index reading above 50 is a positive sign, as it means that the sector is still expanding rather than contracting. However, the slowdown suggests that the economy is losing momentum and could be headed for a period of slower growth. This potential slowdown is a cause for concern among economists and policymakers who are monitoring the situation closely. The Fed will need to carefully assess the situation and determine whether further interest rate hikes are necessary to combat inflation. Balancing the need to control inflation with the risk of slowing economic growth is a delicate task. The slowdown in the services sector is just one of several challenges facing the U.S. economy. Other significant challenges include high inflation, which erodes purchasing power, and rising interest rates, which increase borrowing costs for consumers and businesses. High inflation, rising interest rates, and slowing global growth are all headwinds that could weigh on economic activity in the coming months. These global factors add another layer of complexity to the economic outlook. The Fed faces a delicate balancing act as it tries to tame inflation without triggering a recession. Policymakers must carefully consider the timing and magnitude of any further interest rate adjustments to avoid exacerbating economic challenges. Navigating the economic cross-currents. A guide for investors. The current economic environment is characterized by both opportunities and risks. Inflation remains high, interest rates are rising, and the economy is showing signs of slowing down. However, the labor market remains strong and consumer spending is still holding up relatively well. Investors need to be nimble and adaptable in order to navigate these cross-currents and achieve their financial goals. One key strategy for investors in the current environment is to focus on quality companies with strong balance sheets and a history of profitability. These companies are better positioned to weather economic storms and continue to grow their earnings over the long term. Investors should also consider diversifying their portfolios across different asset classes, such as stocks, bonds, and real estate, to mitigate risk. It's also important to remember that investing is a long-term game. While the current economic environment may seem uncertain, it's important to avoid making rash decisions based on short-term market fluctuations. Instead, investors should focus on their long-term financial goals and stick to their investment plan. Finally, investors should stay informed about the latest economic developments and seek professional advice when needed. By staying informed and being prepared to adapt to changing market conditions, investors can position themselves for success even in uncertain times. Please like the video and share it with others. Thank you for watching.